Right, let me show you what I mean when we talk about money management, when we talk about probabilities. This is just a little bit of an entree into the ways in which we traders think about the odds and the probabilities and money and risk management. It's an old graph. To take this graph of a company called Atlantic Telecom, and the stock's been rising, falling, and so forth. Now, what would happen at this point here, which I've marked as O, the price is roughly at 300, the trader would ask himself, okay, what is the probability of the price hitting a target, for instance, 350? Why has he chosen 350 as a target? Well, he's looking at the most recent high, a resistance level where the price seems a reasonable presumption for it to go. He might do other analysis. He might have done valuation analysis. He might have looked at his technical indicators. Those are the kinds of things we discuss in other CD-ROMs. But the point is, he sets a target, and he'd say, well, what's the probability of hitting that? Well, certainly the stock can rise up quite steeply, as we've seen in the past here and here. So he might assign a 70% probability to that. Now, he might also assign 70% probability because he knows that when his technical indicators, the MACD, stochastics, the other indicators we talk about in technical analysis, when they show a certain pattern, there's a 70% probability that the price moves up and hits a 15% rise. And so he knows from past experience that 70% is about right when the price pattern is looking the way it is looking in this case. So what does he do? Well, he multiplies 70% by 350 and works out, 350 take away 300, so he looks at his gain, which is 50 pence, yeah, and then he says, what's 70% of that profit? Well, it's 35, so he says his expected gain is 35. Now let me run through that again for those of you who are not mathematicians. The expected gain is the probability of the return multiplied by the return. So because it's a 50 pence return, obviously he's not got a 100% chance of getting 50 pence. He reckons there's only a 70% chance. So what he says is his expected gain is not actually 50 pence, it's 35, because that's what he expects to receive. Now, that doesn't mean he expects the price to go here to 335. That's not what he's saying. What he's saying is there's a 70% probability of it getting up to 350. Because there's only a 70% probability of getting there, you put in your revenue side or profits column, you put in 70 times 50 pence, which is 35. And that should hopefully be clear to everybody why he's done that. It's a thing that economists use as well. It allows them to work out whether or not to enter into a trade. Well, if his plus side is 35 pence, now it doesn't mean he's guaranteed 35 pence even then. Of course, the trade might be completely wrong. It might be one of those 30% chances where it falls, in his experience. Okay, so let me just put that to one side for a second. What stop loss will he have to have? And he'll think to himself, well, if I've got 35 pence on the upside, then I don't want to have a stop loss of, say, 200 pence on the downside. That would be stupid because his gain is 35 and his potential loss is greater. So he has to have a figure obviously smaller than that. So he might say to himself, well, what about 20 pence? What if it goes down to 280? Well, 280 is down here. And he's going to think, well, actually, that's fairly reasonable because, look, the price hasn't traded there. And if it has to drop all the way here, he's definitely going to know he's wrong on the trade. He'll obviously know he's wrong because it, first of all, will have dropped. Secondly, it'll have dropped below this support level and hit new lows relative to the preceding 6 weeks. So he's quite happy with a stop loss of, say, 20 pence. He might even put it tighter. He might say, well, it should be 285 or maybe even 290. The problem with the stop loss, which is too tight, is that it could easily get hit as the price just whipsaws, moves up and down, and you're out of a trade, and then the trade continues moving higher. So the stop loss has to be sufficiently far away that it won't be automatically hit, but not so far away that you'd be waiting and waiting and waiting, take a huge loss, all for a small gain of 35 pence. You're balancing this with this, i.e. you're balancing your losses with your profits. Your potential losses can't be so large and your profit so small that it's unworthwhile. Equally, you don't take on the upside. Now, this is what I mean by money and risk management. You don't take on the upside the full price of the target you think the price is going to go to. You take a probability of where it's going to go. And in this case, you think it's going to go 70% chance of a 50 pence gain, which is 35 pence on the upside. On the downside, you could also add probabilities on the downside. I like not to. The reason I don't add probabilities of a 20 pence gain and say, oh, it's just 30% chance of a 20 pence loss, and therefore the trade is even more lucrative, is because I'd rather be more conservative. I'd rather just ignore that and say, does it still make sense? 35p on the upside, stop loss of 20 pence. Well, it does, because if I just did 1 million of those trades, I'm going to make, on average, 35 pence minus 10 pence. I'm going to make 15 pence per trade over the long term. Not every trade, obviously. On some trades, I'll make 50 pence when it goes up. On some trades, I'll lose 20 pence. I'll make 50 on some, lose 20. I might make 10 on some, and etc., etc. But my expected gain is 35. My loss is 20. And that's how the probability system works for money management. We're looking at the downside, we're looking at the upside. I hope you understood that. If you didn't, just rewind back and listen to it again. It's a very important point. It's actually quite simple, but it is very important. Okay, let me look at the odds in a bit more detail again. Now, with a stock like this, we're looking at Abbey National, and it's falling, bounces up again, falling, bounces up again, falling. Keeps on going lower and lower. Now, our trader, and I'm not going to go into technical analysis in this part of the presentation, but I'm taking it as read that our trader is thinking to himself, he looks at the MACD, he's an expert in technical analysis because he's gone through the technical analysis CD-ROMs, and he says, right, okay, this suggests that this price is about to move higher because it's got, in technical language, a series of higher lows on the MACD, and the price hasn't confirmed this. So anyway, bottom line, he thinks the price is going to go higher from where it is here at 360. And he draws the downward trend line, and he sees that there's some resistance roughly around here. Arguably the price has broken through that resistance. So now he says, well, look, I want to go long on this. So what's my gain? What's my potential gain? And what's my potential loss? Well, let's start off with the loss if the price is at 360. And he says to himself, well, you know what? How do I pick? On a money management basis, how do I pick a point where I know that that's where I should put my stop loss? Where on a money management basis, I know I will be wrong if the price hits this level. And the way a good trader reasons it is this. Where would the price have to go from this point such that I would then know that I am wrong in my analysis that the price was going to go higher? And he would reason it this way. He'd say, well, you know what, if it's truly broken on the upside and is no longer in a downtrend, then the price shouldn't return below this resistance line. Because if it's broken to the upside and is on an upward trend and my analysis is correct, it should go in this direction. If my analysis is wrong and it's still in its downtrend, then it would go in this direction. So if it goes in this direction, my analysis is wrong. Where would I know I'm definitely wrong? Where he could argue, oh, I'll know if I'm wrong, even if it goes as low as this, or if it goes to the previous day's low, or the 3-day low. Now, depending on how risk-averse you are, you might decide to take this point. Equally, you might say, well, you know, I won't definitely know I'm wrong because the prices can be quite spiky. It could drop to that level and rise again. I won't definitely know I'm wrong. So let me not put it there. Maybe I'll put it here. Our trader in this case has decided to put it here. Why? Because not only is it a 3-day low, it's actually the low for quite a few months because it really goes around this point. So he says, well, I'm going to put it at roughly 320 pence for argument's sake. So if we're going from 360 to 320, our potential loss is 40 pence. If our potential loss is 40 pence, then our trader reasons, well, you know what, I want to make sure my potential gain is at least double that. Put aside 70% probabilities in that for the second. He says, I want to make sure my gain is at least double my potential loss on a money management, risk management basis. That's my risk. I want to make sure when I play the game that I've got double the upside potential. Because if I keep on doing a whole load of those trades, and let's say, for argument's sake, trading is just a 50-50 ball game, then I'll still be profitable over 100 trades because half of the trades will have made me roughly 80 pence, half the trades will have lost me 40 pence. Well, I'll still be up 40 pence on average per trade. That's how they might work out things on such a thing. So he says, well, how likely is 80 pence then from 360? And it puts me to 440. How likely is it the price is going to go to 440? And he might reason, well, of course, the most likely target is this, but can it break through that, go to this, and then go up here? Can it go up to 440? And what I'm doing when I talk you through this is I'm talking you through the mental processes a trader makes as he is trading. This is the processes I would be showing you if you were standing over my left-hand shoulder at my trading desk. This is how I would reason it if I was teaching you. So I'd say, well, how likely is 440? And he thinks to himself, well, I've seen this pattern before. It's fairly strong. So my analysis tells me it's fairly strong. That's a resistance level. The price is capable of having relatively sharp moves. If it's broken from the downtrend, then it should hit that target relatively straightforwardly. I'm happy for an 80 pence gain versus a 40 pence loss. I want to go into this trade. What will he do next? Well, he'll fast forward and he'll say, ooh, okay, and then this is what's happened. The price has started moving. It's hit his target. He might have exited there. Probably did, because he saw it hit that target and then drop down below again, make a one-day low, and he probably thought, ooh, this is going to be the fall. And if he did exit there, he might kick himself because it continued going higher. Well, that's fine. He got the profit potential he was after. He won't kick himself too hard. Equally, he might have at this point said, well, no, wait a minute, let me look at the MACD. My technical analysis tells me the MACD is still strongly rising. I'm going to stick with this. And he might have thought, I'm going to stick with it. And again, he might have got out here a few days later, same price point, a few days later. But that doesn't matter. The point is, you saw the analysis, you saw the risk level, you saw the profit target, and you saw how it worked. Now, he won't bloody-mindedly hold on to 440 if the price all of a sudden comes to about here and starts dropping again. He'd exit if his analysis told him to get out, or if Abby gave some fundamentally bad news like earnings were plunging. He might get out. Equally, he won't wait for it either to hit this level or this level. He's probably going to move this stop loss higher as the price moves higher because he wants to protect some of his profits. So he might say, well, the stop loss is at a 3-day low. So when the price is at this point, he might say, what's the 3-day low? 1, 2, 3. Well, that's the low point for the past 3 days. So he might put that as a stop loss when the price was up here. When the price is up here, 3-day low would take him to here. And that's how he might work it out. Equally, he might look at his technicals and just say, well, no, I'm not going to have a 3-day low. Look at this. It's rising so sharply. I'm willing to watch. It might be a 5-day low or a 10-day low instead. But that's basically the reasoning that happens for the trader. In the next chapter, we'll go more into some of this reasoning that we do as professional traders in risk and money management.